How many of you with the show of hands have ever heard of me before? Okay. Very cool, very cool. And then I always like to ask the other question, so I'm going to put your hands down over here. How many of you with the show of hands don't know who I am? I've never heard of me before. Fantastic. Fantastic. And just out of curiosity, how many of you with the show of hands wouldn't raise your hands even if I bribed you to? Yeah. Fantastic. I knew that there was a couple of folks out there. Good to be with you guys. Okay. So just, you can see on your screen right here, and I believe, raise your hand if you can see my screen. It should just be a picture of me from 2006. I don't look as young as I did anymore, but I'm sharing my screen okay? And you can see, hi, I'm Trading Trainers AJ Brown. Great. Fantastic. Trading Trainers been around since 2003. And like I said in the intro there with Renee, we've been giving insights to our folks every evening. We've been recording hour-long videos of what we're trading right now and what we're going to be trading tomorrow and giving it to our users since then. But today I want to talk a little bit more. How many of you with the show of hands have any experience with options trading? Fantastic. That's awesome. And how many of you, with a show of hands, would say options trading is not something you've ever delved into, or any derivatives trading for that matter? And by the way, everybody can see on your GoToWebinar webinar control panel that you've got this little vertical array of buttons hanging off of the edge. At the top is an orange button with a white arrow on it. And below that, there's maybe 2 or 3 other buttons, and one of them at the bottom is your hand-raising button. So when I say raise your hand, how about everybody just show me really quick that you know how to raise your hand now that I showed you where the button's located? I like my teaching sessions to be interactive. I like to make sure that I know that you guys are paying attention. Good. Excellent. 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 There should also be a question and answer area down there as well. Cool. So I want to talk to you about what I call the 6% protocol. This is a program that we actually started about 7 years ago, and I haven't taken, back then I took about 100 people, and I haven't taken anybody since then into this program. And why do I call it the 6% protocol? 6%, well, first, just in case, I want to click through this because my team would kill me if I didn't make sure I let you know that I have a CD of the Month Club and I have a home study system in options. And I'm going to actually cancel out of the slides of this slide set because I think that's all you guys need to know about me. You can go and look all over online. There's tons of people who have talked about AJ Brown for the last 14 years, and so there's, if you just Google Trading Trainer, TradingTrainer, you'll hear all about us. You can go to tradingtrainer.com and read all about us as well. This 6% protocol is based on actually doing things that work, right? Doing stuff in the trading, because I'm getting older now. I'm in my mid-40s, and I don't want to sit in front of the computer. I don't want to focus my life around trading. That sounded really good to me in my late 20s, early 30s, but at this point, I don't want to replace a day job with another job. That is not my idea of fun. How many with the show of hands would agree with that? How many, just out of curiosity, how many with the actually are here and what you want to do is spend, 8 hours a day, 10 hours a day in front of the computer researching stocks, and that's your goal in life? Okay, a couple of you put your hands on. This could be something that works with you as well. So stay tuned because I'm going to give you a couple of insights into some strategies. But most of us, I'm all about this thing called efficiency. And if any of you have a math, science, or even a math, science kind of engineering type background, you know what efficiency is. Efficiency is getting a lot back for a little invested. You know, in other words, the minimum, I'm going to write this down and you might want to take some notes, minimum effective dose. How can I get the most accomplished with the minimum effective dose? Now, I'm not going to give you a get-rich-quick scheme because there's no such thing. But what I have found is that there are strategies, especially in the options trading world, that don't require you to sit in front of the computer. Now, there's definitely researching. I see somebody typed in, oh no, I'm very happy to research. Yeah, research is one thing, but sitting in front of the computer on a day-to-day basis instead of making your own hours where you research whenever you can, but if you have to sit between 9:30 Eastern Time and 4 o'clock Eastern Time every day, you've just created for yourself yet another job, sitting in your office chair giving yourself hemorrhoids. I like to do my research in the middle of the evening when nobody's bothering me, when the markets are closed, when the emotions are down, so on and so forth. And so what do I have to do to have the minimum effective dose? And that's what the 6% protocol program that I've had over 100 people in over the last 7 years, and none of them have left, they've been doing, okay? And the idea is if we can grow our portfolio by 6% per month, 6% per month, if you're not taking money out of your portfolio, will double every year. Do the math. It's compound interest, right? It's kind of like that little, and I have a little demo just really quick, and then we'll get on to the actual strategy. Let me make sure I know how to do this from the beginning. Here we go. So a lot of people have said, would you rather have 50 grand right this minute or a penny a day that doubles every day for a month, right? And the smart trader knows that the penny is the better deal. Because if you think about it, at the end of day one, you've got a penny. At the end of day two, you got 2 pennies. But then it continues to grow. Day 8, you've got $1.28. Day 9, $2.56. Day 10, you're already up to $5.12. Nowhere near the $50,000. However, you keep going. And the cool part is, with this little experiment, is around day 24, you've beat the folks taking the penny. I mean, taking the $50,000 lump sum, and the money's on the back end, right? And if you go to the end of the month, you've got $21,474, $836.48. Compound interest, right? Attributed to Albert Einstein. I'm not sure if he actually said it, but everybody says he said it. So the scoop is I'm not talking about doing it for a penny. $1,000. If we focus on the 6% protocol, that means in 12 months it's grown to 2012, 4,048 in 2 years, so on and so forth, 32,987 in 5 years. And the reason why I know that this is popular or possible, over $1 million in 10 years, is because I did it. Not only have I done it, but my folks have done it. In fact, I actually even brought, and you can read about this as well, inner city kids have done this. I took 14 inner city kids. 9 of them actually finished my program. 5 of them slept out. But the 9 that finished my program followed the 6% protocol and did this exactly, right? And that's assuming that you focus on just 6% per month. And one of the things I wanted to bring to light today, because I know some of you can understand, how many of you with the show of hands actually have any experience with trading whatsoever? I think, you wouldn't be on this call if you didn't. I'm going to give you a more advanced strategy. So this is an advanced strategy that I give the 6% protocol people on our monthly webinar that actually parlays that 6% even higher. How many of you with the show of hands think that would be a good thing to learn? Right. So, but I just wanted to explain to you, when I'm talking about the 6% protocol, it's our little program that people are focused on 6% per month. I personally didn't take 10 years, and I personally didn't start out with $1,000. I started out with $5,000, and the reason why I started out with $5,000 is because that's how much you can put in a Roth IRA approximately. So every year I was adding $5,000 and doing my 6% protocol, which actually, if you did the math out, should have brought me to $10 million in 10 years. It took me 7 years of just following my 6% protocol, the minimum effective dose. Now, a lot of people are like, I don't want to wait 7 years, and I fully understand that. And so you get to $100,000 very quickly. Guess what? The next year, you just generated $101,000, $219.65. All right, so you want to stop at $100,000 and start giving yourself an income? More power to you. In fact, you can make this income without having to sit 9 to 5 in front of a computer, right? One of the top jobs right now in the U.S. is to be a master computer software programmer. Earns on average $89,000, but you got to sit in front of the computer nonstop from 9 to 5 minimum. With the 6% protocol, you do your research when you want. So what is it? What is this whole piece? I got my learning community web portal up, so I'm just going to bring you right in because we're going to go do an example trade here. So when people sign up with us, login.tradingtrainer.com, we have a screener. So one of the things that we do, and of course in the Learning Center area, we actually show you how to do the screens yourself in these videos. But why would you if you've got a tool that does it for you? In order to screen through all the NASDAQ and New York Stock Exchange securities and all the various permutations of option combinations, it would take a lot of time, and that's where things like screeners come in handy, right? And so this simple tool here finds fantastic combinations that you can research further for simple covered call writing strategies with protective puts. What does that mean? Let me go ahead and bring up my chalkboard here. I'm going to draw a quick graph for you. Just hand draw it for you. And over here is profit, and of course if you go below the zero line it becomes a loss. And over here is your stock price, all right, along the x-axis here. What is your stock price? Now if we were just trading long stocks, you would see a line here where wherever you bought the stock, if it goes up in price $1, you profit by $1. How many with the show of hands are following? Absolutely, right? Simple. In fact, I listened through the last presentation. She was talking about shorting stocks, and if you think about the profit and loss diagram for shorting stocks, it looks like this. Every dollar that the stock price goes down, you profit by $1. So if you think about this covered call writing strategy, and if you ever go to one of your brokers and you say, hey, I want to get into options trading, I want to do covered call, for some reason they will actually give that to you without any sort of questioning because somebody told them that covered call writing strategies is one of the least risky option trading strategies out there. I would actually argue with that, but you wind up getting a premium above and beyond the stock that you purchased, and so long as the stock stays above a certain value of the option you bought, you're going to get to take this premium home with you. We call that an instant dividend. It also becomes for us a profit buffer. So if the stock goes down by a certain amount, we don't get affected by it because we've made a premium up front. It's basically buying stocks at a discount. Usually the discount that we look for from our tool is around a 10% discount. Now, that 10% discount actually allows us in traditional circumstances to purchase for ourselves a put. And the reason why we would want to buy a put is because, and this is why I would argue with the powers that be that claim that covered call writing is one of the least risky strategies out there, it has an infinite downside. How many with the show of hands realize that? In fact, I've had people come up to me when I speak at live engagements and they go, AJ, yeah. I thought covered call writing was the least risky strategy out there. I said, well, they'll have you believe that. And they said, well, I was following a recipe for covered call writing, and for the first 10 months, I was making between 5 and 8% every month. And I said, well, that's fantastic. And they said, but 11th month, the recipe never told me what to do. If the market went down, the market went down. Not only did I lose all that money I made in the first 10 months overnight, I also lost half of my investment. How many with the show of hands have ever heard a story like that or had that happen to you? Absolutely. So this is where that protective put and other sort of strategies that we have part of our 6% protocol program come in, and it actually shunts any risk, and therefore our return on risk actually turns up from small numbers like 6% all the way up to like 33%, 34%, and now we start to get people's interest. In fact, just very quickly, this is our sample portfolio that we've been running. It's actual trades that we're doing following the 6% protocol to a T. And as you can see here, in a particular trade gave us 7.9%. We've done this one 2 months in a row, 15 days, 28 days, 53 days total, 23.6%, right? This is PHH Corp. These are just ones that the screener found for us. 53 days total, 18 on the first round, 23 on the next one, 12.9%. 12% over here. We'll look at a couple more of these trades. Some of them got interesting with that put, and I'll show you how that works, but we'll come back to that in a moment. So what's the variant I want to teach you? Because if you know anything about option trading, you've probably been introduced to covered call writing before, even covered call writing with a protect, like the put. So that's not anything new, and you didn't come here to learn just about that stuff. We want to know about really supercharging and turbocharging this strategy. So you guys have some notes. How many with the show of hands have your piece of paper ready? Excellent. let's clear this screen here. And let's actually talk about what's happening here. When we do a covered call writing strategy, a lot of times what we're doing, let's see if I can pull this up here. Is, for instance, we're buying Amazon. We're buying the stock. And then after we buy the stock, we sell back the call. And the reason why I guess the powers that be say that this is a really nice strategy is because you're covered. Because you've bought the stock in advance, they call it covered. You're safe, if you will. So for instance, this is a trade on Amazon that's actually available right now. So by paying for Amazon up front and then selling back the call, we actually made an instant dividend. And you might say, well, why is the instant dividend a multiple of 100? Many of you know that option contracts are sold in lots of 100. So you have to buy 100 or sell 100 of options at a time, which means you have to have the Amazon buy 100 shares of the Amazon stock as well to make this work. But this is just an actual trade that we've been doing. So the different components are what happens if Amazon closes above 840. If Amazon closes above 840, they actually take that stock from you and they give you 840. So on each share of stock, we would make $11.23 of profit. At the same time, we made up front the $51.55 of profit. So overall, for every single share that we did, we'd make $66.38 of profit, or an 8% return on investment. Now, if Amazon doesn't make any motion, then we make that $51.55, and we get to keep Amazon. That option in June winds up expiring worthless. So we would do it again. And that's why when you looked at my portfolio, you saw quite a few candidates where we were month in and month out. Here's a candidate right here. Here's a candidate right here. Our option expired worthless, and we did not get called out. There are times where it expires worthless and we get called out right away. Let's look for another example really quick. There's times where the stock starts appreciating so much we make the decision to actually buy back those options we sold and let the stock run. Look at this candidate on Career Education Corp. 22.7% return on our invested capital. Okay. Again, we'll come back to more of the portfolio in a second. Now, what if it goes down? We have that profit buffer of $51.55. It brings our break-even price much lower. So it can go down. We've got a buffer built in. The other component is if it looks like, or if we want to make sure it doesn't go even further, here's Darling Ingredients. It's a little bit more affordable. $12 to get into it, 40 cents back per option. That brings that break even, or that profit buffer, sometimes we call it a cost basis, down to $11.61. Let me stop right there. How many with the show of hands are following? Fantastic. By the way, I do see your questions. Like, for instance, somebody said, Isn't Amazon pretty expensive? What do you got to do that? Stick with me, because this is where I started to ponder around and go into some more advanced options trading strategies, and that's where we're going to be heading in a couple seconds. So stick around. In this particular scenario on Darling Ingredients, 100 share option contract, we'd invest $12.01, possible return of about 39 cents. Why 39 cents? Not 40 cents? It's because if we got called out, we'd get called out at $12. So they give us $12. We paid $12 in a 1, so that penny is actually a loss towards the 40 cents gain. So we'd make $39. So in just a couple of weeks, we've already locked in 3.3%. But now, what if we decide to protect it down at $11? That's called marrying a put, so that if the stock should drive down past our profit buffer and down past $11, we don't want to have unlimited risk. We bumped our break-even price, our cost base is up higher, but now our max risk is not unlimited. It's only $76. Our return is $24. So now our potential return on risk is now 32%. Now, again, I'm not happy enough with that. I'm not happy enough with that. So one of the scoops is we have to make sure that our underlying symbol is in a good place. I'm going to give you 10 criteria that I look for after my screener has come up with mathematically the best candidate combinations to pursue, what I would look for even further. Please write these down. By the way, how many of you with the show of hands have any kind of interest in technical analysis or quantitative analysis or even just fundamentals analysis? Raise your hand. This is just the basics that I look for. Number one, I like to use the 20-day Bollinger Bands on a chart, and I like to count the number of candlesticks, just the bodies, not the wicks, since we've been outside of the Bollinger Bands. I call it my candlestick count. I want my candlestick count to be high. Write that down. By the way, should you ever come and hang with me, I can show you how to do this analysis in under 5 minutes, but I'm just explaining it nice and thoroughly for you. Number two, I want to see those same 20-day Bollinger Bands. I want to see the width constricting, giving me some consolidation. Number three, I want to see my exponential moving averages. I call this my butterfly pattern finder, and I don't want you to confuse that for you option traders out there with the butterfly trading strategies. The 5, 10, and 20-day EMAs, I don't want to see them necessarily converging on each other, but instead oscillating with each other. And again, I don't want to give you a course today on technical analysis, so I want you to jot these down. You can look these all up just with our friend Google.com, puts us in touch with all kinds of things around the market. I want to just list these out for you. And if you'd like, you can definitely, let me put at the top of this little document, you want me to explain it to you better, just write me an email. I'll give you a nice explanation. AJ@tradingtrainer.com. I also like to look at support and resistance lines. I want to look at support and resistance lines where they've been tested. So I want to test it at least 2, but 3, 4, or 5 times better. Same with resistance. And then I want to look at those same lines instead of on a daily 6-month, write that down, daily 6-month. I want to look at that on a weekly 2-year and a monthly 10-year. I'll even look at it on a 30-minute chart. And I want to see if those same lines of support and resistance play through on all those different time period combinations. I love my point and figure charts. If you don't have access to point and figure charts, just go to stockcharts.com. I'm not even related with that company. But they have a free tool for doing point and figure charts, stockcharts.com. I don't even know who they are. I've just been using their tool for the last 15 years whenever I need a quick free chart. I like to look at the point and figure charts and see the same lines of support and resistance. Point and figure charts, if you're not familiar with them, you should be. They're very powerful tools. They increment every time there's a reversal. Here's an example. I'll just go to stockcharts.com and show you what I'm talking about. I'm going to type in the ticker symbol that I've been looking at, GLNG. And instead of a sharp chart, you pull down from this menu here, point and figure charts. GLNG. And as you can see here, it looks a little bit different. Let me make it nice and big for you. And every time you go from a column of O's to a column of X's, it means that the stock reversed on you. So it doesn't necessarily mean a certain amount of time has passed, but rather how long has it been since we saw a reversal. You can see all sorts of lines of support and resistance this way that you wouldn't see on a normal price and volume chart. If you haven't delved into point and figure charts yet, you should do it. It's hot. The other thing I also like to do is evaluate price by volume. This is a quantitative analysis trick. How much trading has occurred at each price? You can see this histogram. I just added it. Again, this is a free charting tool. I'm not related with the company at all. I put price by volume, and you can see now at each one of these prices, if I reversed there, how much trading actually caused me to reverse. It also doesn't hurt to just look at a naked chart, right? Look at a price and volume chart with no other indicators and see if you can quickly categorize it. Is this a sideways mover? Is this an uptrender? Is this a downtrender, right? A lot of people are so quick to take a look at charts and throw all kinds of different indicators on it that they forget about just looking at it naked and looking for price patterns that your eyeballs can see. Excellent. Now after the naked chart, here's one. I jumped from 8 to 10. I want to go to 9. One more thing that I think is uber valuable, and that is, it's called the average actually it's the channel width divided by average channel price. Channel width divided by average channel price. Channel width. Come back to number 4, and you've identified support and resistance lines. Let's look at this guy that I've been looking at. I've been looking at this guy all morning, and I've identified that I've got some support at 26, and I've got some resistance somewhere up here, probably around $28.50. So support 26, resistance $28.50. So what's my channel width? How wide in dollars is my channel? How many with the show of hands just came up with $2.50? The width of this channel is $2.50. The distance from $26 to $28.50. Now, what's the average channel price? So what's the average of 26 and 28.50? I'm going to have to cheat because I'm not going to do math on the fly here because I'm a lazy trader. 26 plus 28.50 divided by 2. My average channel price, $27.25. How many with show of hands are following? Awesome. So let's do the ratio. Channel width over average channel price. $2.50 divided by 27.25. This fraction, in our case, it's 9.2%. How many show of hands, are you okay that I rounded it like that to 9.2% instead of saying 9.1743%? You okay with that? All right, my 9.2%, the number I'm looking for is between 10 and 20%. For something that's going to rate high for a sideways mover, that's going to be good for my covered call. This is right on the edge, 9.2%. And that brings me back to one last point. I'm giving you these 10 criteria here. We're going to give you number 10 right in a moment. But I have to tell you that you're not going to, find a stock that passes with flying colors on all 10. As with anything in trading, you're going to do, even if it's just in your head, a statistical compromise. And what this does is it builds confidence. The more of these you get, and the more of these that go like solidly black instead of white, the more comfortable you will be in doing the trade. The more higher the probability of success, and you're just balancing risk with reward, right? That's what trading is, by the way. You must manage risk, and again, the presenter before me really emphasized that. I couldn't agree more. Every time one of our 6% protocol trades come up, the first thing we do is we measure the amount of risk to our portfolio that it could bring us. And that's how we decide whether we pick it. We don't look at reward. Reward is the frosting on the cake. We manage risk. Any trader who has gone bankrupt was not managing risk. If you sit there and you manage risk, your portfolio will grow. All right, so sorry for getting on a high horse. Number 10, dividend. So again, I like free tools, google.com. Type in your ticker symbol. So we're looking at GLNG. We can switch on over to Google Finance. So finance.google.com, GLNG. And this will tell us whether they are giving dividends or not. You can go out and use their cute little freebie charting thing, go out to 1 year, and in 1 year I see that they gave a dividend every quarter, once in June, once in September, once in December. Why do I care about dividends? If a company gives dividends, investors are more likely to be comfortable with the price not necessarily appreciating. So being cognizant of dividends means I'm already knowing whether or not investors in that company are okay with it continuing to go sideways without having any sort of asset appreciation. So I evaluate these 10 criteria actually very quickly. Again, I can show you how to do it in 5 minutes or less to decide whether any of my candidates that mathematically would make sense to do a covered call on are worthy. But now, again, the returns are nice, but I want better returns, and that's why you're here. So here's where I ran into a little bit of a conundrum, and that was, what can we do to really make better returns on a covered call? We can either try to increase our gains, and on a covered call, our gains are just limited to the amount that we can make by selling the call, so that's kind of fixed. In fact, if I use the put as a protection on unlimited downside, I'm actually deficiting the amount that I make on my sale of my call. So I guess what I'm going to have to do is reduce my cost basis. So as I was going through my thought process 10 years ago, I said, well, one thing I could do is instead of buying and then selling the call, I could actually, when I was looking at profit and loss diagrams, I could actually sell a put and take on the margin requirement of having the cash in my pocket in order to create the same scenario. Now, again, your broker will cringe at you doing that, even though it's exactly the same as writing a covered call. They just like you to be covered. They like the word covered. I don't think they have any rhyme nor reason to why they do things, but they'll cringe, and you may or may not get better prices. It's almost like a game of arbitrage. So, okay, there's one opportunity, but you're only going to maybe increase your gains by 1% or so, or maybe just cover your commissions. So the next thing I went to is, what if instead of buying a stock, what if I decided instead to do the synthetic equivalent? Buy the call and sell the put. They would protect themselves, and again, I'd have a margin requirement on one side, but on the other side I'd get a premium that would pay for the cost of the other. But when all was said and done, so let me go through my options. How to reduce our costs to increase our returns. Number one was synthetic equivalent of the strategy, namely a naked put. Not much additional return, and only sometimes. And broker will challenge you. So that's not the most fun. How about synthetic equivalent of the stock? So that's long a call, short a put. Again, not much additional return, and only sometimes. take these notes. You can look up these two strategies, but I'm telling you right now, they're not the best. So that's not what we pursued. So how about number 3? Some of you know where I'm going with this. It's the strategy I'm using solidly right now. Let's use a stock replacement strategy on the stock. Something that acts like a stock but costs a lot less. How many with the show of hands can think of something that acts like a stock but costs a lot less? Some of you have your hands up. So quick primer for those of you that aren't option traders, and I'm wrapping it up here. I know that they want to kick me off the line here. You've got your option, and your option is actually got two different components. When you look at the option price, somebody said a long call. Close. Close. Two different components in an option price. One of them is called time premium or premium value, or if you're academician, it's called the extrinsic value. Extrinsic value is very much a function of time decay, implied volatility, stock position. It's the emotional component in the option price. And then, of course, there's the extrinsic value. Once the option is in the money, intrinsic value, sorry. The intrinsic value is the amount of price of the option that is built in. In other words, it's the amount left over when the option expires. It's the actual hard value of the option. What's neat is as you go farther and farther away from the strike price of the option, you have more intrinsic and less extrinsic to the point where you have parity. That option moves dollar for dollar with the stock, but is at a discount. So take, for instance, again, I've been playing before I came to you today with this GLNG, GOLAR. I was pulling up the option chain. So the first criteria is we have to go deep in the money. And I can show you how to do this, but when I do the math for you, you're going to be really excited. Go deep in the money. Currently, the stock itself is trading at about $27.22. Let me zoom in here so you don't have to squint. $27.22. If I go deep in the money, and I'm going to go all the way out, it's called a leap. I'm going to go to the January 2019 leap. Again, the stock is at $27. The deeper I go in the money with the call option, the more it's going to act like a stock. So take, for instance, if I go with the $20 GOLAR, expires all the way out. That says January, here it is. Expires all the way out in January 2019. I'm not sure why it says January 2018 and then 19, but we're looking at the 2019 series. Somewhere between $10.50 and $12.40. So now it's not going to expire for years. It's got mostly intrinsic value. In fact, probably the extrinsic value, and we could calculate it, but I don't have time to do that. But the intrinsic value is more than 95% of this price, and it's much cheaper than $27.22. Right? It's $27.22. This one reduces our cost base. Now, What I've created here is called a diagonal trade for you option traders out there, but I'm using a deep in the money, far out in time leap, which basically is behaving at the stock. The only thing that I'm not going to benefit by doing this is if the stock does give dividends, I won't be a benefit to it, because being a leap holder doesn't give you rights to the dividends. That wide spread is definitely acceptable in this case. Turns out that this leap now can protect you just like the stock does for if you get called out, because then you can cash in your leap right away and make the spread. So the 6% protocol, the way that I advertise today's talk, was giving you a way for, and this is a short course that I teach the program, instead of just taking the stock, selling the call, buying the put, and making what we aim for as the 6% protocol, let's find the optimal stock replacement where we can actually reduce our cost basis considerably. Let's just quickly do the math and then we'll tie it up. And again, if anybody has further questions, I want you to ring my bell at aj@tradingtrainer.com. I'll answer your emails. But in our one case, we're talking about, here's the option chain. What if we bought for $27.22? Buy to open for $27.22, and then we'd sell to open in the case of the leap, we would buy to open, and again, somewhere between the bid and the ask price. I'd have to get some probably around $11.45 is what I would put my trade to go out and buy this at. And then if I were to do a buy right, and usually I don't, usually I try to get a better price for the call. Let's go back to our near-term call. We're going to look at the April, since we just had our March monthlies expire yesterday. Yesterday was quadruple witching. We can either do the 25 or the 30. It looks like the 30's got some nice value to it. So somewhere between 40 and 55 cents, we'd sell it for about 48 cents. That's what we would put our target price to sell at. So now just looking at our cost basis and our premium return, our cost basis $27.22. This is without even being called out. You can already see the difference in our numbers. 48 cents on an investment of $27.22 gives us about only 1.8% return. Dropping it down to 48 cents on $11.45, now we're up to 4%. Factor in the possibility of getting called out, and the price goes through the roof. This is my strategy du jour these days. So let me write out those instructions again. Use the screener. Get the green light. Look for the stock replacement in a deep in the money, far out in time leap. My English teacher would have killed me 30 years ago if I didn't put in these hyphens. I've been doing these trades since about the end of 2014 when the market started to go flat. And even through the Trump rally, these trades have performed fantastically. We can still use our protective puts on them. Everything else works the same. It's just that we're tripling the returns over regular covered calls, making it much easier to hit our 6% protocol. Again, 6% protocol, you make 6% per month on your portfolio. You're going to double your money every year. Here are actual returns. This is a trade I'm currently in right now, PHH Corp, and we've accumulated over 35.3%. Not trying to make huge, unforgettable home, people always like to talk about these home runs. So here's the scoop. We are opening up the 6% protocol. We actually have not opened it yet. But I'll open it up for you just for today. We're going to be opening it up later next week, officially. But I got invited to speak here, and I'm so stoked. So here's the website, tt4.me, 6pp order. I think that is in the chat area, tt4.me, 6pp, so you could click on it right there. If you click on it, 6pp, oh, I'm sorry, tt4.me/6pp order. I'm actually typing it in, but you should just click on the link. It's way easier. Type it into your browser. Make sure you spell me, M-E, and you'll come to the order form. Definitely listen to these couple of... Hey there. Well, that's me now. So you saw the picture of young me. That's me now. Listen to these folks who have been working with me, and good testimonials. I want to draw your attention right here. Make sure you understand what you're getting, including the DVD that I'm going to send you. And as you can see in the 6% protocol web portal, which you would get access to immediately, these are the trades we're trading over the weekend. We're preparing to trade Monday morning, so get started right now with me. People would actually charge a fortune, I think, for this type of strategy. Six months, $497. I have a little guarantee that I've never heard of before, but I know that this works because, like I said, this is my 6% protocol. It's not just me that's profited on it, but here's the strategy. It's called a double your money back guarantee, and that is if you pay $497, get involved for 6 months, meet with me monthly. There's a monthly webinar. There's a chat area within the web where you can get a hold of me. I answer back within 6 hours. At the end of 6 months, if you're not profiting, not only will I refund your money, but I will take $497 out of my pocket and pay you for the 6 months you tried. Now, of course, I got to make sure you're going to show me what you did. We're going to get involved here together and make sure that, because it's not that I want to pay out $497. I want to have you be successful, and I'm not going to just pay $497 to anybody who's a maverick. So you're going to show me why it's not working for you. But if you can show me that it's not working, I will refund your money, and I will take $497 out of my pocket. So there's no risk. And I'm only doing 100 more traders. One, because the webinars are very intimate, and I like to answer your questions during the live webinars. And if you're not there, if there's more than 100 people there, it gets too unwieldy. And the second, more important reason is the screener looks for high implied volatility tickers. And if more than 100 people are trading those type of candidates, we would actually move the market. So the limit on 100 is a hard limit. PayPal, pay with credit card. We also have the ability, if you actually, and a lot of people do this, they don't want to do it just for 6 months. They want to do it for 3 years. So we have a massive discount. For 3 years, it's $14.97 instead of, I think it would be $3,000 or $4,000. You don't have to do that. You could just do it for 6 months. But I think it's actually, the truth be told, how many current subscribers are there? There's the original 100. I believe the link is already posted in the chat, but let me put it up here on the screen for you again, just in case. All I ask for you is go read it, read through that, go to that link and read through it. And as I mentioned, we haven't opened the doors yet. We had to get together and put that order form together because nobody's come in on this round. Here you go. 6% protocol. Renee, that's all I've got. I hope you guys enjoyed yourself.
All right, thank you, AJ. Appreciate you speaking to our group today, and I'd love to have you back on again.
Oh, can I ask this? Renee, may I answer this one question that just popped up?
Yeah,
Can we pay the difference after 6 months? Yeah. So I have a lot of people who after about 2 months, 3 months come back and say, hey man, I really want that deal for 3 years. Absolutely. So if you want to just try it for 6 months and then after a couple months you're into it, which you're definitely welcome, just send me that email. Somebody asked me, it's aj@tradingtrainer.com, and we'll definitely just pay the difference to get you onto the 3-year program.